The following is a presentation of TFNN.
All right. Welcome, everybody, to today's Option Hour. My name is Don Kaufman, and I will be the host today of Option Hour. And, of course, as you guys know, this is a call-in show, so please give us a call with any option-related questions here at 877-927-6648. We had some great callers last week, and really a lot to talk about today. So be sure to again give us a call at 877-927-6648, and we will answer your questions live. I'm also reading the chat room here today, and give you kind of a quick market recap as I really see it here today in just the next couple of minutes. So before I get into that, I'm reading a little bit through the chat over here in the Tiger Den, and I got to tell you some hysterical stuff I'm reading in there. So first of all, there was an argument about 3G and 4G. I love that stuff. By the way, if you guys ever want to call up and talk technology, I'm a closet tech geek, so by all means, call us and we'll talk technology as well. And when I say technology, trade-related technology, obviously. ThinkorSwim is, software. We also build iPhone and iPad apps. I mean, really, everything from Android to BlackBerry. I sit here every single day with all my different cell phones, testing out technology, all this ThinkorSwim stuff. So, call up and talk to me about that as well. One of the best comments, by the way, I saw in here, and I know this is supposed to be an option hour, but one of the best comments I saw in here in a long time was something about divorces. 1 in 5 divorces cites Facebook as a possible reason. That is awesome. So thank you for that comment in there. And I think the nickname in there was Polar, who writes in quite a bit. So awesome comment in there. Another thing about Facebook, how many people get fired over Facebook? I bet you it's greater than 1 in 5 out there in terms of firings in the workplace there. I'm sure it's extremely high. Anyway, with that, kind of a quick market recap as we go along, all right? I love this. There's people chatting in, you won't see me on Facebook. I got to tell you, I don't have a Facebook account either. And that's not because, hey, I'm not into Facebook. It's, when you run a portion of a company or, I'm on the road quite a bit, I don't like to mix, the work and the home life there, and Facebook does just that, and that's just not going to happen for me. Anyway, with that, cracks me up. Futures. So ES futures, E-mini S&P 500 futures down 12 today. NASDAQ futures getting knocked down even harder, down 25. Dow futures down 87. And of course, all right, so we heard that, oil is cited as one of the reasons here today. I mean, great. Oil's up basically $2 today. And I look for oil, I always look at /CL. People are like, can you have Brent crude? I mean, who looks at Brent crude? Not that widely spread. The vast majority of people are looking at light sweet crude, again, up about $1.90 on the day. Ultimately, there's a lot of talk, and I was listening to CNBC this morning. I've been listening actually here to TFNN. A lot of people are citing oil up being the reason market's down. Bottom line is this, okay? There's a lot of people looking to sell this thing right now. They're looking for any reason. It doesn't matter at this point, why. I don't know why all the time you see traders trying to decipher why is the market moving down. Because the bottom line is we've gone straight up, the past 6 months, we're going to sell off sooner or later. So ultimately, the bottom line here is we're selling. We've got some decent selling pressure. I'm just, I'm not heavily buying it right now because the VIX is just not popping like I'd like it to see. I'd like to see the VIX up 2 or 3 on selling pressure. And again, we've actually seen a sell-off today, rally back up, sell-off again, rally back up a little bit. And it's anybody's guess by the close today. We're going to have to watch order flow very, very carefully as we move forward on the day. Anyway, again, it's a call-in show. I don't want to stand, in here and just yabber on about markets all day. We want to answer your questions. So give us a call at 877-927-6648. Our first caller is Bill from New York about rolling out options. So, Bill, you there with us?
Yes, I am, Don.
Oh, great, great. Have I met you in the past, Bill?
Yes, I have.
Okay, good deal. So what do you got for us today?
Well, I had an option that I sold, a covered call, and it's now in the red.
Okay.
And my question is, Is there a time to sell and roll it out? Is it like, or do you let it run until it's close to expiration, then roll it out?
Well, this is an interesting question. So you say that the covered call is in the red. Are you meaning that the stock is down, or the call that you sold is down in value?
My call is it's down in value. If I was to buy it back, I'd take a loss.
Okay, that's actually a good thing. That's a good thing. The only way you can lose on a short call is if the stock is moved up. One thing that you have to realize, and do you want to mention the stock, or you want me to just use any?
Yeah, Skyworks International, SKWS.
I have no idea what that is, but let's just use a general stock. I'll just make it easy and use something like GE right now for this example. So, GE is at $20.50. And the reason I'm using GE and not your underlying is the liquidity of GE, just make this explanation a little easier.
Okay.
So GE is at $20.50. And ultimately, with the $20.50, you're going to go out and sell, for instance, like 21 calls. 21 calls are trading for 53 cents right now. So if the stock goes up, okay, you just sold these calls for 50 cents, but if the stock goes up, the calls, of course, are going to go up in value, and you're short those calls. So assume that you sold a call for 53 cents, now you got to buy it back for $1. But you made, the intrinsic value that you lost. When I say intrinsic, the real value that you lost on the short 21 because you're long the stock. So it's an intrinsic wash, meaning that if you lost 50 cents of intrinsic value on the calls, you made the intrinsic value back on the stock. So losing money on the short call is a good thing. All you need to do is if there's very little or no time value left, the extrinsic value, you just roll up and roll out, okay? But you can never look at the covered call as a standalone that you're losing on that short call. Because, again, I'll tell you, it's a good thing on there. So, ultimately, Bill, when you're rolling these options, about 4 to 10 calendar days before expiration is an ideal rolling window. A lot of people, is that when you typically roll, or when do you normally roll these things?
Well, I've been doing it a week before, yes.
Okay, and the reason is, and I always hammer this home, like a lot of people, they still wait until like Thursday or Friday of expiration week. And I'm going to tell you right now, that ain't a good thing to do. You wait till like Friday of expiration week, and it's kind of like market makers at that point. They have you pinned. And in fact, that they know that you're trying to close that trade, and you'll see bid-offer spreads start to widen out, especially in less liquid underlyings out there. The other thing that I always kind of warn people away from is that sometimes covered calls expire worthless. Yours is not going to in this case, but sometimes covered calls expire worthless. And when they do, some people let them expire worthless on a Friday, then they wait to the Monday after expiration to sell another call. And the bottom line is, how many other people in the world do you think do that? Well, a ton of them do. And what that in effect does, it basically lowers the implied volatility on Monday morning because there are so many individuals selling premium on the Monday after expiration Friday. You are better off rolling positions about 4 to 10 calendar days prior to an expiration cycle to take maximum advantage of decay and not get caught in a rough position. So does that help you out anymore?
Yes, it does. Now, just one question. If you go long, I mean, what if you got a month and a half left? Just let it run until that week before?
So the real question is, when the option that you sold goes in the money, and let's say that the option that you sold, it went in the money, you have to look at the extrinsic value left in there, so the time value. So if you are $1 in the money on the call you sold, is there any time value left in that short call? If the answer is if there's less than 10 or 15 cents of time value, buy it back right now, early, and roll it to the next month. Because, the covered call, it doesn't do you any good, all right, having a covered call on if there isn't any extrinsic value. There's no time value. That's the whole purpose of the covered call, is to collect that extrinsic value. Otherwise, basically, if you're just short a call that has no time value, you're short a call, you're long stock, you're not making any money on there. You have nothing but downside at that point. So hopefully that helps you out a little bit. It really is a matter of looking at intrinsic and extrinsic. And if you are, and I don't know if you're on ThinkorSwim, but if you are, you can actually pull up intrinsic and extrinsic value under your information layouts in the trade tab, and it'll tell you exactly how much time value is in the option. And again, if that time value gets extremely low, roll the option immediately. And that's, you try to be consistent on those covered calls too. It's not much of a trading strategy, but it's a fantastic investment grade strategy for you there. So, all right, Bill, anything else?
Just one thing on a condo. When you space, if you're gonna buy like a 45, would you sell the 40 and the 50 on both on the short and long on it?
You're looking at a regular condor or an iron condor?
An iron condor. Is that an iron one where you buy the middle and you sell the both ends?
Actually, the iron condor is typically selling in the middle and buying the wings. So the iron condor is a premium selling technique that really is most effective in a lot of the index products. So like the spiders right now are at $131. You can sell an out-of-money call, buy an out-of-the-money call, then sell an out-of-the-money put, buy an out-of-the-money put. So a condor, just a condor, would be calls with calls, okay, or puts with puts. But an iron condor is selling an out-of-the-money call spread and selling an out-of-the-money put spread.
Okay.
So a little bit of a distinction in there. Which one are you shooting for?
Just a condor.
Just a regular condor. So a condor is a version of a butterfly.
That's what I meant, a butterfly. That's probably
sure. Yeah.
Okay,
so
that's what I meant.
Butterfly, and basically go out and butterfly. What you do is you basically click on the central strike there. You're selling two of the central strike and buying the wings. Now, however far out you buy your wings, okay, it's going to make the butterfly that much more expensive. You know, a $5 butterfly, hey, there's no problem with that. If there's, $5 wide strikes, do a $5 wide butterfly. If there's dollar wide strikes, like you're looking at something like GE or even the spiders, the spiders, you can do like a $2 wide butterfly in there. It's really, what you got to get about the butterfly is this. On a butterfly, if a butterfly is a $1 wide butterfly, meaning, for instance, in the spiders right now, they're trading at a 131, let's say. If you buy a $1 butterfly, that would be, for instance, the 130, 131, 132 butterfly. And if you pay 8 cents for that butterfly, that basically entails there's approximately an 8% probability that the underlying falls within the range of your butterfly, okay, on expiration. And that's basically how butterflies are priced. It's pretty interesting. So you're always going to pay more for the butterfly the wider it is, because it gives you a higher probability of making money on that particular trade.
Okay.
Yeah.
All right. That's very good. I'm glad I talked to you.
All right, good deal.
You straightened out a lot of things for me here.
Yeah, good deal. Sounds good there, Bill. So thank you very much for calling in. Okay. Bill with the New Yorker accent. Gotta love that. I'm originally from New York, but I've also lived out in Los Angeles and most currently Arizona. I've even spent time out in Chicago for a couple of years. So we're going to take another call here in just a second. But remember, this is a call-in show, and hey, we love it when you call. Call with technology questions. Call with option questions. I don't know, just call. Anyway, the number here is 877-927-6648. We have Mark in L.A. with an XEO weekly and technical question. So, Mark, what do you got for us? You there?
Yeah, I noticed the XEO spreads are maybe 60 cents to $1 wide. I'm just been watching it. I haven't traded it yet.
Yeah. You're going to hate my answer on this, but go ahead.
When I go bigger down the road and it blows up on me, I pretty much have to get the bid price. I can't get any kind of decent mid price to get out.
So, all right.
Just worried about the spread.
There's no easy way to tell you this, Mark, but listen, have you ever met any of the guys at ThinkorSwim over the years?
Yeah, I have. You and Tom and a couple of the shows.
You probably know this. Most of the guys at ThinkorSwim, we originally met, in pits like the OEX and XEO. I mean, if you went to our trade desk is really comprised of about 45 former market makers from the OEX XEO product. And the consensus in our office on a day-to-day basis, not one of us trades this product anymore. Okay. I mean, literally, nobody trades it anymore. The spreads are wide, but the other problem is it's only single exchange listed, where a lot of good products today are multiple exchange listed, meaning that this product only trades in Chicago. And it's not that Chicago's a great exchange. They're fantastic. But the market makers understand that basically if you want to do business, you got to come back to them. And it's ultimately not a great marketplace. And by the way, volume and open interest in the OEX and XEO, it sucks today compared to what it used to. God, it's a product that nobody's asked me about in a really long time.
Everybody's going to equity weeklies, huh? More so than? Yeah, I
you know what?
figured XEO, be careful because of the European. You couldn't get a signed prior.
Right. However, that being said, I know that sounds good, the European being assigned and so forth. You're never going to be assigned unless those puts, your short puts, are deep in the money. I mean, the bottom line is you got to have short puts deep in the money. Otherwise, you're not going to get popped early on there unless there's like a dividend payable. Equities have got problems too, because if there's a dividend payable and you're short a call that's in the money with a div coming out, you're going to get, when it goes ex-div, you're going to get popped early and end up paying that dividend there. But ultimately, look to the spiders. Look to products like if you like the XEO product itself, which is the S&P 100. A lot of people don't even know what the XEO and OEX is. It's the S&P 100. The XEO, of course, is a European style. The OEX is of course American style cash settled, which is very funky. But ultimately, stick with things like the spiders. You could even utilize the RUT if you wanted to trade what I call a big boy product. And I call things like the RUT the big boy product here. And the RUT doesn't have all the weeklies and stuff on it, but ultimately the RUT has got the multiple exchange listing designation. The other real big boy product here that's I guess pretty decent is, of course, the NDX. And the NDX has got decent liquidity, but again, the weeklies are wild in here. The bid offer spreads are kind of wide. So
that kind of scares me if I had to get out and.
You're going to get crushed. The biggest problem with all these products like the RUT and the NDX, the XEO, and SPX, the single biggest problem I see, when volatility hits, you're screwed when you're in a position in these things. As a retail client, man, it's so hard to get out that I, myself, still trade the spiders predominantly, although the spiders cost me a hell of a lot more in transaction costs and commissions. And I know that going in. The bottom line is this. I watched the day the flash crash happened. I traded heavily in 08, 09 during that crash. Even years going back, every time heavy volatility hits, every client that trades in the RUT, the NDX, the SPX, the OEX, the XEO, they're emailing us because they can't get out and the spreads widen out to $3 and $4 wide. I never see those emails, though, from clients trading the spiders, the IWM, and the Qs. It's just, I think people are better off there. So do you also have a technical question?
Yeah, I had a technical question. Real quick point about that flash crash. I call it the vacuum crash because the vacuum cleaner was running, and I thought it was affecting the wireless or something. It wasn't. Yeah. But anyway, iPad. If I get the iPad with a 2G AT&T plan,
yep.
Will that run ThinkorSwim maybe 7 hours a day for 20 days or so, the 2 gig plan, or will it
you know what? So ThinkorSwim just released an iPad application. For those of you guys who don't know that, it's not the main full-blown ThinkorSwim that you're seeing here as my screenshot. But the new iPad application it's sweet. It went in totally different directions, like all this visual interface stuff where you're actually touching and kind of grabbing liquidity in the market. So 2 gigs at 7 hours a day, you're going to be close, man. I'm not going to lie. You're going to be close. But are you always running it on the AT&T network?
Yeah. Well, right now that's what they got, right? That's all they have is the...
Well, no, because you can run it Wi-Fi, too. So if you're, at home, you're going to run it Wi-Fi.
Okay.
And you're free and clear. If you're at a Starbucks, you run it on Wi-Fi, you're free and clear. And I got to tell you, I actually have the Verizon cards that I use for my laptop, and I've never hit, and I teach classes all over the place, and I've never hit my limits on that Verizon card, but it got close. But I'm only out there 8 days, 10 days a month. So, I
guess I'm thinking it's either AT&T or wireless, but I guess it could be both. Yeah, that's a good point. That wireless would cut into that 7 hours a lot.
Absolutely, man. Use Wi-Fi. It's always going to be faster, too, right now anyway. When we go 4G basically is like Wi-Fi, but if you can use Wi-Fi, use Wi-Fi out of your house.
All right. Thanks a lot for your answer.
No problem. Thanks a lot, Mark. Bye-bye. All right. So some fun stuff. Somebody says in here, buy a netbook. I got to tell you, so the software for, trading is not as good yet on the iPad as it is on any laptop or any computer, especially with ThinkorSwim. I mean, this software is unbelievable that I'm trading on right now. But the iPad it's pretty damn good. It's the best of any of the mobile devices out there. But I am also in agreement with a lot of people. People say, buy a netbook. I'm reading the chat right now. Buy a netbook. Great, you can. I still like to carry my laptop. I mean, ultimately, the laptop is, kind of king for me. The other thing is I do have an iPad, and I brought it home, and my wife took it, and I have never seen it since, and I'm probably never going to see it again. But, hey, I'm amused by that iPad. It's a lot of fun. So with that, we got another caller here in a second. But, again, give us a call. Hey, even if you want to argue technology, I love it. Again, I'm a closet tech geek here. I'm also fairly Mac-friendly, as Mac-friendly as it gets. We run both PCs and Mac here in my house, not to mention the iPad. So, somebody said it perfectly. He said toy. That is it right there. I got to tell you, the iPad, the iPhone are the single best toys I have ever owned. So give me a call, 877-927-6648. We got another caller here, Jim from Palm Harbor. Something about SDS call. So are you still there, Jim?
Yes, I am. I just wanted to know which products and vehicles, and for example, you're trading in. I'm not getting the bang for the buck, and also for the attention and time that I'm putting into some of these trades. For example, I mean, I've had a bearish bias, like everybody else has gotten hit over the head. Anybody that's been short, and today it looks like we're finally getting paid off. So what I did in the one account was the TZA. I actually sold March 40 puts.
Yeah.
But the spread is, any other product, you can put a stop and go to lunch, but this one is so wide. I mean, it's right now, bid ask is March 40 TZA puts from 234 to 257.
Yeah, they're definitely wide. There's no question about that whatsoever. This is a wide spread, and you got to be really careful too on when the spread is this wide. During different times of the day, they can even widen the spread and pick a stop because it'll trigger a stop in there. So you got to be really
I can't put a stop in there, but so I don't know whether if you had a bearish bias, whether you'd be going right to the Russell and look for a Russell where you'd have more of a movement, or would you go right to the SPYs where you have a more of a movement and a tighter spread?
And you're just totally bearish, and it looks like you want to get some leverage, yeah?
Exactly. Yeah, I mean, I was lucky. I only got 14 filled at 297 at the high tick of the day. So on paper, I've got a nice little profit. But and finally, TZA is moving while we're talking.
So I'll give you two different ways. First of all, when you look at like TZA, obviously it moves in tandem, even with like the spiders and stuff like that. But it gives you that leverage. The SDS obviously is the spiders, the double inverse. But when we're trading options, it's who cares? Just trade the damn spiders. Because you're already getting the leverage of the options, but you're getting tighter markets, much tighter markets in the spider marketplace. That being said, there's one other place, if I were you, that I would consider, and I do trade them a lot, utilize futures, okay, or options on futures. If you want heavy amounts of leverage and you're willing to accept that with super tight markets, use the futures because there's not a better place. The one thing that always bothered me about this SDS, so it's a double inverse. It's got like decay rates associated with it. The spreads are a little bit wide on it. And, ultimately, it's still not as good as a futures product. And I know, you might not trade futures, but it's something to definitely consider in the future to try to get that leverage. And ultimately, have you traded futures before there, Jim?
Yeah, I have. But again, I know the ES Mini is probably the best product because you can actually get filled if you put a stop and they're not going to run it over.
Right, right.
Pretty much unless it's overnight, then they can really gap it around. But during the daytime, you'll get a fill right within.
100%, 100%. And it's the way that the futures markets actually runs through Globex. So Globex and the Chicago Mercantile Exchange utilize a different order routing methodology. It's actually considered a first-in, first-out market. Mm-hmm. With stop orders, man, they are fast and furious in there. So, it's pretty good protection. Ultimately, though, rather than use the stops, you could, of course, utilize some type of a vertical spread. That'll help you mitigate your risk. But those futures products, I can't say enough good things about what the CME is doing lately. And I find myself trading more and more of those products to get long or short. And right now, I'm not in an ES position right now. I'm short NASDAQ futures because I think that thing is just way over. Over.
I'm also got a position in the SDS, the March 20 calls.
Yeah.
I mean, would you? I don't know how. Again, it's only I've actually stepped up from 10 to 20 and 30 contracts because basically, if you get a 4-cent move on 10 contracts, I mean, it's not even worth your while.
Right.
So would you sell into this burst of weakness that we have right here? I mean, a stop. Unfortunately, again, here's a product again where the bid ask is 162, 168. So yep. I can give away my $400 profit in a blink of an eyelash if the ES goes back over 13.15.
So this is, again, so the inverse, of course, of our spider. It's easier to get this done either in the spiders, and obviously you've got to trade more contracts in the spiders, or you got to trade like an ES option in here because you're going to get tighter spreads. Between the commissions and the give up in here, you got a tough market, especially when right now, okay, it might only be 6 cents wide right now, but this sucker's going to widen out. I mean, we're 62 by 68 right now, and the deeper it gets in the money, the wider it's going to get. All right. Okay. So the reason is the higher the delta in an inverse related product. Okay, when I say like a delta of like 80, in fact, I'll pull delta on my screen here real quick. But when you see a delta of like 80 or 90, they're going to start to jack up the bid-offer spreads. They're going to widen them out, and they're doing that to protect themselves. Okay, in that trade, it sucks. From a client perspective, there's nothing I can tell you other than utilize.
Don't trade that product and look for something else where the spreads are tighter.
Exactly.
Okay.
And ultimately, that's why the volume of the spiders is what it is. That's why, the E-mini contract right now is, exploding in terms of growth. Is people have finally come to the realization that, a 1 penny wide market, that's $1 on a contract there. And I think a lot of people complain about commissions, but to this day, we still have, if I look at the entire broker-dealer of, TD Ameritrade, ThinkorSwim, people still give up drastically more in the bid-offer spreads than they pay in commissions. And when we finally close that gap, we're going to be okay. But most of the traders listening right now are trading monstrously liquid products, and they're not doing that. It's kind of, there's a small faction, of course, and people always have heard this, a small faction of people that make decent money in the markets. That same small faction all trade the exact same products. Nobody really deviates from the products that you trade. But I will tell you, the products you trade will make or break you, though, in this industry. Giving up 6 cents on either side of a market is ridiculous right now.
Right, and especially, I've got 20 of them, so now you're talking $120 that you're playing with that makes the difference.
The way I think about that is, even if you give up like 3 or 4 cents, that used to be our living. That's what market makers did. And if every time that I did a trade, okay, you gave me 4 or 5 cents, that's golden. I'll do it all day long. Ultimately, if you trade products that have penny-wide spreads, there's no edge for anybody in there. That's like the utopian marketplace that, I got to tell you, if you asked me about this 13, 14 years ago when I first got involved in this business, said, hey, the spreads will be penny-wide, 10, 12 years from now, I would have said there's no way in hell that's ever going to happen. And here we are with penny-wide spreads. In 9 different markets, 9 different exchanges, let's just say, making markets on these things.
So your favorite vehicle is the SPYs in terms of puts and calls if you're trying to intraday it, or you're going right to the futures?
No, you know what? So on an intraday level, I'll trade either or. It depends on my conviction. If I just want to get what I would say just, hardcore long or short, I'm going to the futures. If I'm just sitting here playing around and want to scalp a little bit, I'll trade spiders. And if I want a lot of bang for my buck, I'll trade some weeklies out there. The weeklies also have wide spreads, but the spiders have better spreads than do a lot of the other weekly products. So, some people are actually talking right now in the chat room, too. And it really depends on the conviction, because you got to remember, one ES future, one E-mini S&P 500 future is equivalent to buying or selling exactly 500 shares of the spiders. So when I say you better have a little bit of conviction, it's about size. What's conviction out there? Yeah.
Okay. Well, thanks for your time. Have a
All
great
right,
day.
no problem. Thanks for calling, Jim. Great. So, I love talking about like futures products because when we started this show and Tom Sosnoff started this show, way back when, we always just talked about options, but ultimately we find ourselves in our own trading utilizing futures more and more. Now, so futures have always had this, kind of mystique around them of high-risk vehicles. Trust me, they are. Futures, okay, used by most retail clients are the crack of the trading world. I say that in all seriousness. Futures, when I say they're the crack of the trading world, they should give you guys the first one free, because when people get hooked on these things, they do not stop. The reality is most people utilize futures as a directional vehicle on the retail side of the trading world. However, on the professional side of the trading world, most people utilize futures, okay, to be able to mitigate risk. So the first thing you ever learn about a future, okay, as a trader, if you're working for a firm, is you learn that one ES future is equivalent to 500 shares of the spiders, and they teach you that basically because you're going to be out there buying and selling spider options and hedging to the futures markets. All right, so it's just, a little bit of a relationship. Understanding the products you guys trade in is critical to your longer-term success. So with that, I don't have any more callers in the queue. You guys need to call us. So give us a call today at 877-927-6648, ultimately because we just need somebody to talk to. It's lonely out here. Hey, you know what? Let's talk a little bit about that. Markets here have sold off a little bit more. I'm actually watching multiple chats right now, so I've got a chat up the Tiger Den, but I'm also, of course, watching some of our own chat rooms in here, and I also talk on Instant Messenger all day, some of the guys at ThinkorSwim office, and I'll tell you what, chat rooms like the one you guys are in right now and communicating back and forth to other traders is absolutely also critical. I'm not based in Chicago anymore. I actually live out of Scottsdale, Arizona. I'm doing this radio show today out of Scottsdale, Arizona, and I love getting in chat rooms like this because ultimately every one of us that's sitting at home trading, you're like isolated on a little island by yourself, and it's great, okay, to be able to bounce ideas off other people. Hey, call in if you've got questions or chat them in, and not necessarily to me, just talk, okay, to some of your other traders out there because everybody's got various opinions. Anyway, I crack up too as I look, as I'm watching chatting here. Sorry, as I read and chat and talking at the exact same time. Only because it gives me a reason to want to take the other side of the market. Sometimes when you guys make comments in there, some people are like, "I am long for this reason, this reason, this reason," and I'm like, "That's exactly why I just got short." There's always another side to the market. So we've got another caller here. And again, before we take this caller, you give us a call. Anyway, the number here is 877-927-6648. Somebody's asking about rolling spreads, how and when. We'll get to that in just a minute. But we've got a caller on the line right now. It's Larry. Larry, you there?
Yes, I am. And you live in Scottsdale?
I do live in Scottsdale.
Well, I live in Tucson, plus we have a place in Paradise Valley that we go to a couple times a month to visit Mark Douglas, so sometimes we'll have to have lunch or something. But I have a question.
I used to live down in Tucson, finished up high school down there.
Yes.
And, Tucson, I still have a lot of family lives down there. It's still the Old West.
Yeah, it really is. We still carry guns into the supermarkets, into the restaurants.
Oh, yeah.
I have a question for you. What would be a good spider to look at, SPY, for a potential really big drop into May, where you don't have to spend more than about $500 on the put?
All right. So you're looking for a big drop into May. So we're
minimum of 20%, maybe even a lot more.
All right. Well, there's a couple ways that we got to talk about this. I mean, the first thing is if you want to risk a nominal amount of capital, like $500, which is fine, okay? It all depends on account size, too. So, that could be a huge amount of money here, not a huge amount of money. But if you want defined risk, you're going to be limited as to what you can do. So we're going to look at one or two things on a defined risk spread. We're going to look at either selling an out-of-the-money call spread, okay, or we're going to be buying a slightly in-the-money put spread. It's kind of one or the other. But we're not going to be able to do a huge amount with the $500 only because when you mentioned out to May, there's a lot of time value in there. So we've got to be careful what we do. The other thing that's probably not going to be right for you is just getting short a future because in a futures market, you can lose, $500 in 5 minutes. I mean, that's how fast futures can move. So ultimately, I'm only going to go out and utilize the April options right now. Even though you're looking to the trade for May, all right, if there's going to be a downside opportunity, you'll be able to roll and plenty of time to roll from April to May, but with limited risk, okay, and limited capital in there, it's going to suit your needs best to use spreads, okay, in April and then roll to May. You'll get the best bang for your buck on that roll.
Do it on the last rollover day in the May?
So you're going to roll just a few days before expiration, like about 4 to 10 days before expiration, you can roll the spread out. And I always say that 4 to 10 day window, and I'm going to talk about that a little bit more here as the show goes on. But ultimately, if you've got a lot of conviction, you can sell a very close to the money, like one strike out of the money vertical spread. Like I've already highlighted the 133 calls. I'm going to right-click, go down to sell, go to vertical, and I'll make it like a $2 wide spread. Now, there's not a lot of upside in this. I just pulled up a $2 wide call spread for a 90-cent credit. Basically, the most you can make on a one-contract trade is 90 cents. The most you can lose is basically $1.10. You do 10 contracts in here, it makes it a little bit more interesting. On 10 contracts, $900 of risk. So obviously, depending on your risk, and it's, I know you mentioned $500, but obviously then you do 5 contracts. It's completely and totally dependent on, to you. What's nice about this product, though, the Spiders, is it allows you really to fine-tune right down to the dollar of how much risk you really want. So that's one scenario, is selling like a 133, 135 call spread for like a 90-cent credit. You okay with that one? Because we'll give you another one here. Wow.
Well, I can tell you, in 1987, I was in the October puts. It expired on the 16th with the Dow down 106 points, and then Monday it was down 500 points. The difference between the October and November puts was $2.5 million.
That's a good time.
Yeah, I mean that was just one of those times. I don't think we're going to see that type of a move, but I'm looking for something, to swing for the fences and only, put up $500. I'm thinking of people in the den are always asking me that, and I think the futures are right. They're not for everybody because they move too quickly. But if you buy a put and put it away, it'd be a low risk insurance if the market does turn down.
So the next thing I'm looking at here, is buying a put spread. So I'm never an advocate of just going out there and buying the naked put. Now, once in a blue moon, if you want to take that downside shot, you can do it. Okay? And there's an interesting thing I'm going to talk about right now. So you can buy a put spread, but if you really think that we're going to push down hard as far as 20% down, you can also go out and buy an out-of-the-money put calendar or a series of out-of-the-money put calendars. Okay, depending on how far you think we're going to go down. Like I'll go down to the 122 strike, for instance, in April. And I know I'm not like 20% out of the money. I'm about 10% out of the money here, okay? And buying this calendar, and I'm going to explain why buying a calendar might be an interesting play right now, but turn around and buy this April-May 122 put calendar. And it's 86 cents right now. What's interesting about the calendar spread is the back month options. The May options have a lot of sensitivity to changes in implied volatility. You can even utilize, instead of May, you can utilize June if you want more Vega in here. So what you're basically doing with this spread is you're setting up a volatility play. If we go down anywhere from 10 to 15%, the VIX will explode, okay? And this little trade becomes a volatility explosion at the 122 level is just, hey, that's the first, blow down. It's about 10% out of the money. And you can get a nice payout. You can basically have about $1.60 of risk for a debit in this spread. This thing can pay out as much as $3 or $4. So you may actually get like a 1 to 3 risk-reward ratio in a spread like this put calendar. But again, I'm trying to keep us as defined risk as possible. The other thing is this put spread, okay, can pay out really well. It definitely has limited risk, a lot of salvage value, meaning if all hell breaks loose and it goes against you, you can still salvage some of that $1.60. It does not, though, provide you the upside of just going out there and buying a put. But the problem with just buying a put is that there's a low probability associated with it. So, everything in options, though, is a trade-off. It's really what you're comfortable with there, Larry.
Okay. Thank you very much. I appreciate you answering my question.
Yeah, thank you.
Okay, bye-bye.
So, thanks. Kind of, again, an interesting question on there. And when I said everything's a trade-off, listen, I could go out right now, and if I think we're going down 20%, I could buy a slightly out-of-the-money put. But buying a slightly out-of-the-money put, let's say we buy like these 30 delta puts. This 30 delta put in April, for example, in April over here, its probability of expiring, if I drop down to probability of expiring, there's only about a 33% chance that this 127 put expires in the money. All right, now that's based on an expiration date. That's all fine and dandy, but we don't need us at 127 if we buy this put. We need us at 127 minus the $2 we paid for the put. We got to be all the way at 125. The probability of the trade happening there is not that good. Now, that being said, although the probability of success is low, the payout of buying a put could be huge. Okay, if you really thought we were going to explode to the downside, you could just buy a put. Or you could use a combination of buying a put. You could use a put calendar. You could even do what's called a ratio back spread into some of this. There's, and each one of those trades has a risk reward and a payout associated with that move one of those trades is not necessarily better than the other. It depends on the magnitude of the move. And you guys have to understand that options, okay, are not just about volatility. Options are about magnitude. If the magnitude of the move is big enough, okay, and you do the right strategy, the payout could be enormous in something like a back spread or buying a put. But ultimately, okay, you got to get that move, and it has to have magnitude if you're going to be able to buy those puts and let it pay off. Anyway, kind of some interesting stuff there to talk about because it's been years since I think I've talked about magnitude on a trade. Anyway, with that, let's get another caller in here. Are there any other callers out there? The number, of course, is 877-927-6648. Only have a couple of minutes left. You must call us now. I want to talk a little bit in general about the markets, and we've had a couple of questions come up in the den here, and I'm reading, okay, as much as I can as I'm talking over here, trying to read some of your questions as we go along here. Some people are actually mentioning, the volume right now is not spectacular. You know, you're right. I'm taking a look at the volume here in the spiders, about 123 million shares on here. I'd like to see volume really, really pick up hard if that selling pressure is going to get real. So, you know, watch this market closely into the close today. It looks like, you know, I saw a couple people in another chat room earlier talking about, hey, take a look. It looks like we're going to be green by the end of the day. I know that almost every day has ended up here, but now it looks like we're going to have a decent down day. We're kind of set on the ways here. My guess today is we actually close on some of the lows of the day. So, you know, a couple of things that we look at. As I'm a little bit more of a tape reader and not so much a market technician, as I'm reading tape over here, I look at futures. Of course, I don't look so much at the Dow, the Qs, the VIX. The VIX is up $1.51. I really, ultimately, in a larger down day, I'd like to see that VIX with a little bit more conviction. Let's feel a little bit more, you know, pressure there in the selling. Order flow is what really drives this VIX. When I say order flow, people coming out and buying puts. That order flow is driven by some big fund managers. Trust me, if all of us as retail clients got together and started buying puts, it's not the same order flow and the same pressure as a couple of big fund managers coming in buying puts. So we'd like to see that order flow being generated really pop the VIX up a little bit more. As we said, oil has kind of been up, of course, all day, and oil has been what is accused to be driving the markets lower, but ultimately oil's up $1.60, but I believe the markets are looking for a reason to sell off anyway. The one thing that's kind of a non-confirmer today, if we were really panicking and really selling, you'd see bonds the exact opposite here. People are typically dumping money into bonds on a real true down panic day. Of course, today you see bonds kind of meandering a little bit. Now, bonds today might not be confirming because Bernanke opened up his mouth. And anytime Bernanke opens up his mouth, bonds trade against him. So if you guys are not familiar with QE1 and QE2, it is not the ship. QE2, of course, is quantitative easing number 2. And that QE2 out there, of course, has what they basically do is they go out there and they buy the bonds. So they're buying like 30-year bonds to drive interest rates down. Every time Bernanke opens up his mouth, the bonds seem to trade against him, meaning bonds trade down, interest rates trade up. You gotta love it. We're also getting a lot of confirmers from some of the high flyers today, Apple, Google, Netflix. When I say high flyers, those are really what's in play today, what people are watching. And, of course, I've got all three of those stacked today. All three of them are down on the day. With that, we're going to take a call right here. Paul from Boston, time decay on weeklies. Paul, are you there?
I am, Don. Thanks very much. I wanted to kind of pick your brain on what you see are typically really good advantageous plays, be it butterflies or what have you, to take advantage of time decay on weekly options.
You know, I don't know if I've ever mentioned this before in this particular show. So weekly option, pretty much near and dear to the hearts of a lot of people at ThinkorSwim. And the reason is Tom Sosnoff and Scott Sheridan, the two founders of ThinkorSwim originally, they actually developed the original product, the weeklies, and sold that product to the Chicago Board Options Exchange. The best part of that story is they weren't originally called weeklies. When the product was presented to the SIBO, it was called a quickie. Way funnier. So then the Chicago Board Options Exchange changed the name to the weeklies. But, hey, you guys, you call them quickies. Anyway, with that, easiest way to take advantage of time decay of the weeklies, if you haven't traded this product before, you're exactly right. The time decay is fast and furious. First thing is, if you own some stock in an equity or an index that trades weeklies, you could sell a covered call. The second primary way to take advantage of time decay in these weeklies here, all right, is to use the type of a vertical spread. And the vertical spreads are straightforward. The problem with a vertical spread in here, are you familiar with a vertical spread there, Paul?
I am, yes.
The problem with the vertical spread, when you put it on in a weekly, you're 100% committed, meaning that if the trade goes against you, there's no fix. Now, you could roll that vertical to the next weekly, but there is no easy fix for a trade that goes against you in a weekly. You're 100% committed with that capital. So keep the trade small. But the vertical spread ultimately is the easiest and straightforward way to take advantage of it. The other thing you could do, and this is not for the faint of heart, is you could sell some premium naked in here. Selling premium naked, your margin is going to be absorbent. Now, that's completely kind of up to you. But if you like sweating for a week, you'll never sweat more as when you sell an option naked and feel the fear of that thing going against you.
Right.
Well, have you tried any of those strategies out yet?
I have not. I've just looked at, just as a for instance, say, looking at, say, an Apple selling a 345, 335 put spread. And the profit versus the risk seems to be extraordinarily. It's like your risk is like, I don't know, about $8,000. Your profit is maybe about $900 or something, depending upon the time during the week when you put it on.
100%. So this particular trade is pretty straightforward. Right now, the weekly's got 3 days left, right? This Apple spread, the 345, 340. I'm actually pricing the $5 wide spread. Is trading for $1. Okay, so it's basically $5 wide spread. You got $1 credit. It's $4 of risk in there. The $10 wide spread is about the same. And that's because there's only 3 days left, and you're going to sit there and you're going to pray for the next 3 days that we close in there. Okay. The one thing is, like about Apple, I would not sell naked in this underlying. Sure. You'll wake up one day if something happens to Steve Jobs, and this thing will get crushed. Yep. And I don't know if you're trading on ThinkorSwim, but if you are, if you look at Apple. Have you seen that the new toy on there? It says MMM. It's a market maker move. It's giving you the intraday move. It says MMM on the top of the screen, and it says $2.30 plus or minus. What that basically means, the market maker's implied volatility is pricing a plus or minus $3 or $2.30 move on an intraday basis on this. That will help you to which spread you utilize in the weekly.
All right.
But you know what? You're right. When it comes to Apple like that, you're taking a shot, and they're paying you for it, but you're gonna feel pain if that thing goes against you. The problem is, again, there's like no hedge, especially in Apple. If it blows against you, Apple can open down $8-10 easily, and there's no fix for it.
Great. All right. Good to know.
Yeah. I wish people call up and they're like, "Wow, I was looking for a miracle strategy." You just totally that was disheartening. But that's the reality of this weekly product. On the flip side, though, what a great product. I mean,
it is.
Every expiration is or every week is expiration week. It's good stuff. So, anything else, Paul?
That's it. You've given me fair warning. I appreciate it.
Yeah. Thanks a lot. Thanks for calling in.
Yep.
So I love when people call in about products like weeklies and futures out there, and just looking at the market right now, it looks like we're headed another leg down here. So futures were trading down 12.50 when we started this. Now futures are down about 15 on the S&P. Talking a little bit about weekly options, for example. If you got conviction and you like to take those positions, hey, you can get it done. You can get it done on the weeklies. The only problem is you're totally committed when you're in a trade on the weekly product out there. So keep that in mind. Anyway, taking a look here at the chat, there's nothing too exciting going on right now. We'll kind of, only a few minutes left here, so we'll start a little bit of a wrap-up here on the day. So I had some interesting callers throughout the day. Everything from people trying to create trades in the SDS, possibly should be utilizing the futures a little bit more to be able to not only mitigate risk at tighter markets and tighter bid-offer spreads. And that's something I kind of want to hammer home here, as we kind of close in the day, is trade products not only that you're familiar with, okay? If there's one thing that I always leave people with anytime I teach a class is narrow down the number of products that you look at on a day-to-day basis. Okay? One of the things that makes me insane is when, I know there's all kinds of cool scanning tools out there, and even on ThinkorSwim, and I don't care which technology you're trading on, but even on ThinkorSwim, there's, you can scan through some 10,000 different stocks. You're going to scan through the Doji Star, with the abandoned baby bottom. And ultimately, what are you going to find? You're going to find a stock called Joe's Tree Cutting Service that there's little liquidity. The markets are a little bit wide. You've never traded for it. There's only you and Joe from Joe's Tree Cutting Service trading that thing, and it's tough to be able to make money in a market like that. Ultimately, all I'm saying is trade, okay, what's in play. Trade everybody else is trading. We're all here for the exact same reason, and that's just to squeeze a little bit of juice out of these markets. And ultimately, when you give up something in the spread, you're giving up your juice out there. You've got to understand to take advantage of every edge that is afforded to you in this industry. And when I say edge that's afforded to you, you got to realize that when there are markets that are a penny wide, when you look at a spread on a spider and it's 79 cents by 80 cents, that is an advantage to you as a retail client because you, okay, get to do what you want, when you want, how you want. You get to place the trades you want anytime you want. Market makers have to be reactive. Retail clients get to be proactive, search for trades out there, and you have the ability to manage risk. I mean, I'm looking at a weekly option right now, all right, with 3 days left to go to expiration. It's trading a 1 penny wide market. So, stick to your guns. The other thing is be consistent. I trade a lot of vertical spreads. I trade a lot of calendar spreads. That's the entire world of options. It's vertical spreads and calendar spreads. On the side, if I'm sitting home and I'm, doing a radio show like this, yeah, I have tendency to trade futures in and out throughout the day. It's an exciting marketplace, but that's not, okay, my bread and butter, which is options. Anyway, with that being said, okay, we're kind of wrapping up the day here. Hey, hopefully you're short. If you're not, you're losing money, but either way, I'll be on again next week. Thank you guys very much for joining us for the Option Hour today. I'm Don Kaufman, and I'll see everybody next week. Thanks a lot, everybody, and bye-bye.